Hey everyone, and welcome back. So every now and then I do an update to my free spreadsheet resource, which for those who are unaware, I have a free stock analysis spreadsheet that you can download from my website. It's always linked in the description below, and it will make your life a lot easier when you're analyzing businesses and crunching the numbers on whether a business is at an appropriate price to start investing in the business. And over the past week, I've made some changes, adding some things, adding some features, as well as simplifying some areas of the spreadsheet so that it is easier for you to use. And in today's video, I'm simply going to be doing a tutorial of how to download the spreadsheet, as well as how to enter in all of the data into the different sheets and different cells. So even if you've downloaded a copy of the spreadsheet previously, I recommend you go ahead and download a copy of the new spreadsheet, and then also follow along in today's video because there are a number of new things that you didn't have access to before. So I'm sure you'll be interested to check some of those things out. So without further ado, let's jump into my computer and start going through this tutorial.
All right, so over on my computer now, first of all, if you want to download a copy of the spreadsheet, again, it is completely free. Just use the first link in the description below, or you can head directly to www.hamishhodder.com/spreadsheet. Once you do that, you'll have to enter in your email, and the link to download the spreadsheets will be sent to your email, and then that will bring you to this page. So there's a number of different versions of the spreadsheet. I've got some of the older versions. So if you were coming from a previous YouTube video where I was demonstrating something with an older version of the spreadsheet, you can access the older ones here. There's an older Excel version, but the new version 4.0 of the spreadsheet are these 4 buttons up the top here. And the reason why there's 4 different ones are, first of all, there's a 5-year spreadsheet and a 10-year spreadsheet, and that really just depends on how much data you're collecting on a business. Some people like to look at the past 5 years and to project forward 5 years. Personally, as a long-term investor, I like to look at as much data as possible, and at a minimum, I want 10 years of past data, and I want to be projecting forward 10 years. So that's up to you which sheet you want to use depending on, I guess, what businesses you're looking at or what your strategy is. And then there is a 2021 version and a 2022 version. I know these both say 21. The bottom one is supposed to say 22. I'll fix that right after I record this video. But the only difference between those two is what is the latest financial year. So if the company you're looking at has the latest financial year as 2020, then you will want to use the 2021 version of the spreadsheet. If the company has released their 2021 financial results, then you will want to use the latest version of the spreadsheet, which is designed to be used next year once every company has reported their 2021 financials. So simply click the spreadsheet that you need, and that will bring you to a template of the spreadsheet. Now, you are not going to be able to edit this version of the spreadsheet. You need to make a copy of it on your Google Drive. So you need to come up to the corner here, click File, and click Make a Copy. And then you just want to make a copy of the spreadsheet. You can name it, put it in whatever folder you want, and click OK. And that will create a copy of the spreadsheet that will be on your Google Drive and that you can edit. Do not request access to edit the original spreadsheet. It's a public spreadsheet that you can't edit so that it remains a template. So do not request access. That is not what you need to do. You need to click File, make a copy, and save a copy on your Google Drive. So with the spreadsheet downloaded, there is obviously a number of different sheets here that are all being used to analyze a business as a long-term investment. You have the data input sheet, which is where you're going to be entering in most of the data. So sales or revenue figures for the past 10 years for the business. I'll show you where to find all of these in just a second with an example. Sales, earnings per share, equity, and then cash from operating cash flow or cash flow from operations. And what you'll notice is when you click on these headings here on the side, it will tell you where you can find those figures. So equity, for example, is found on the balance sheets, or sometimes called the statement of financial position. So it tells you exactly where you can find this data, in which financial statement this data will be found. Also at the top, you can enter in the ticker symbol, and that will allow us to calculate the number of shares or get the data for the number of shares that the business is split up into, so that we can calculate the buy price for a business or the intrinsic value for a business on a per share basis as well. We've got some 5-year averages, which are sometimes useful when we're projecting forward and there's been a particular year where they've had abnormal profits, and you don't want to use that as the start of your valuation. And then we have our debt ratio calculations for assessing whether the company has too much debt, and also the return on invested capital, assessing management's effectiveness. Again, these have little descriptions for you in the notes here. Over on the next sheet, we've got a pretty basic sheet that helps you to calculate maintenance capital expenditure. Now, this is new to the spreadsheet, but it's something that you're going to be doing with every business that you analyze. So you can enter in the total capital expenditure figure here. And again, there's a little description of how you can find that. And I'm going to go through an example in a second. Then you can estimate a percentage of maintenance capital expenditure. So if you think 50% of CapEx is used for maintenance, you can put that in there, or maybe it's 30%. But you can also manually change the maintenance capital expenditure line in case the management team explicitly tells you how much was spent on maintenance. And there's also just a working out space down here if you wanted to crunch some numbers down below before you enter them into this line. Also, one other thing I forgot to mention at the start is you can edit all of the white cells. So the white cells are areas where you're supposed to enter data. Anything that is grayed out usually has formulas involved and should not be touched. So you can see that you don't enter in cash flow for owners. You don't enter in maintenance CapEx here. You enter in maintenance CapEx on this sheet here, and then it will automatically bring it over here and do that calculation for you. The next sheet is calculating the return on invested capital. Again, you can see you have one line you need to calculate only, which is, or enter in data, I should say, which is the long-term debt line. Again, a little bit of information about where you can find that figure, and cash flow for owners, equity, and capital. All of that is being pulled from the data input tab, so you don't need to touch that at all. One other thing I added to this sheet is some calculations on how much cash flow was produced by the business over the 10-year period, and then also how much cash was reinvested back into the business to increase equity, how much debt was used, and also how much capital increased overall. So you can make some deeper assessments about how much cash was produced by the business, and then how much of that cash went back into the business and how much of it was distributed, maybe in the form of dividends or share repurchases. Over on the next tab, there is absolutely nothing to enter in here. This is simply going to be your calculation of growth rates for these 4 key areas that are on the data input tab, and there'll be a chart. And again, I'll go through an example in just a second. And then finally, on the valuation sheet, there's a couple of things you need to enter in here. So you have your first year's cash flow. So this will usually be either last year's cash flow for owners figure, or if that was an abnormal figure, if it was abnormally high or abnormally low, then you might want to use the 5-year average cash flow for owners in that figure. Growth is, of course, where you estimate how quickly that profit or that cash flow figure will grow per year over the next 10 years. We then have required rate of return, which is our target return. So for me personally, that's 15%, but most people typically agree that this should be between 10 and 15%. And again, there's notes on all of these things in case you forget. Terminal growth rate is our estimation of how cash flows will grow after the 10th year, so year 11, into infinity, into perpetuity. We're typically going to be leaving that at 0, so you don't really need to worry about that if that's confusing to you. And then we have our margin of safety. So on top of the required rate of return, on top of our target return of 15%, what margin are we allowing for errors in our valuation? So usually that's going to be 50%. And then also in valuation, it's important to consider the cash and debt that's on the balance sheet for the business, right? If a business has a ton of cash, then that adds to the value of the business, because it's as if you imagine you were buying the entire business, then you get access to that cash. So you want to be adding cash to the valuation and subtracting debt in the same way. And you can simply enter those two numbers in. It will calculate your net debt, which is simply total debt minus cash and cash equivalents. And it will consider that in the fair value and the buy price. So a couple of changes to this sheet. It probably looks a little bit different, but most of it is still the same. There's a live counter of the share price here now, so you can quickly compare the share price to the fair value per share of the business, as well as the buy price. The only difference here is fair value for the whole business and then per share is based on our required rate of return with 0 margin of safety. And then the buy price is the fair value taking into consideration the margin of safety. So you can see that since we have the margin of safety set to 50%, the buy price is going to be a 50% discount, half of the fair value. Now, while it may seem daunting to go and find all of these figures for 10 years, it's really not that difficult. You have a couple of options, a couple of free options. You can use QuickFS, which you need an account, but it's a free account and you get access to 10 years of financials. If you have a paid account, you get 20 years, but it's not necessary. Or you can use something like Ticker, which has access to some European stocks as well. If you're looking at European or UK stocks, they will be on here as well. Both are very good for getting access to enough data to fill out our spreadsheet. All right, so as a quick example, we're just going to use Facebook, and it was just the first company that came to mind, no particular reason why. So if you're using QuickFS, you can just head over to the income statement and you'll be able to grab the revenue numbers here and the earnings per share numbers from there. On the balance sheet, of course, you'll be able to grab the equity numbers. You'll be able to grab the long-term debt numbers for the return on invested capital calculation, as well as the current assets, current liabilities, and total liabilities used for our debt ratios. And then on the cash flow statement, you'll be able to get cash from operations here. And you'll also be able to get the total CapEx figure, which you can then use to estimate what maintenance capital expenditure is. So in the interest of time, I've just gone ahead and copied all the numbers and then edited that out because that was about a 5-10 minute process, but doesn't need to be in this video. But what you'll see now is we have everything kind of calculating and the graphs working and everything. So over here, I guess the first thing you can see is we've got the 5-year averages for their revenue, although that's probably not super important, but for their earnings per share and for their cash flow for owners figure, as well as for their profit margins, right? You might be using their cash flow margin, which is simply a relationship between cash flow for owners and revenue. You might be projecting forward what happens with that. That's also why I've included the cash flow margin chart here, so you can see what margins are doing over time, and maybe you can use that to influence your decision about what you should expect from margins in the future. So with Facebook, you might expect that these lower margins is what we're going to expect more of in the future, for example. Our debt ratios over here have calculated, and these boxes will light up either green, yellow, or red, depending on whether they satisfy our requirements. So in this case, I demand a current ratio that's above 2 and a debt to equity ratio below 0.5. So if those are satisfied, it's green. If the current ratio is below 2 but above 1, it will be okay, it'll be yellow, and the same applies for the debt to equity ratio when it's between 0.5 and 1, and outside of those ranges it will be red, and the same sort of thing is applied to the return on invested capital, which we want to see above 10%, not just in the last year but over the 10-year average. In the CapEx spreadsheet here, you can see I've entered in the total CapEx figure from the cash flow statement, and then I've estimated, let's say, that 30% of Facebook's capital expenditure is for maintenance, and then the remaining 70% is used to invest in growing the business. And therefore we get a calculation for maintenance CapEx. But as I said, you could manually change these if the management team explicitly tells you we spent X amount of dollars on maintenance CapEx or something to that effect. We then have the return on invested capital sheet where I just had to add long-term debt. So for Facebook, they don't have any long-term debt in any year except 2012. And we can also see the chart of return on invested capital that's improving over time, which is obviously good. And we can see how much cash flow they produced and where that went. So for Facebook, they don't pay a dividend. They do some share repurchases, but for the most part, they've just kept cash in the business, either invested or kept it as cash on the balance sheet. So it makes sense that they've produced about $125 billion in cash flow, and equity has increased a very similar amount. We then have the growth numbers here. So we can see the growth over the last year, over a 3-year average, 5-year average, 7-year average, and a 9-year average. So for example, this sales under this 9-year column, this figure, 41.79%, represents the per year compounded growth of sales over the past 10 years, over 9 compounds. And then we also have the chart so you can see how growth is trending. So of course, for a business that's coming off high growth, their growth is fairly consistent, but it is trending down over time. And then with valuation, of course, we want to enter in the last year's cash flow for owners figure, which for this business was $28.1 billion. We could do some estimates for growth. These are just I've just picked some random growth rates here. This doesn't mean anything, but you could put a range of maybe 10 to 20% or something like that. Whatever your analysis and what conclusion you reach based on what you think about the industry and how the business can grow in that industry. We're using a 15% target return, no terminal value, although maybe we could put this at 1 or 2%. As I've said in here, most of the time you'll probably set terminal at 0. If you think that they can continue to grow their cash flows, then at the most, put it at 3. You really don't want to put this higher than long-term GDP growth. So keeping this to very, very low numbers is important in not blowing out your valuation. Let's say we demand a 50% margin of safety. We've considered their cash and debt. Now, I've actually considered cash and short-term investments in that figure, and that's because they have a lot of treasury bonds, which we can consider as cash equivalents. So I've added that in there, and that, of course, means that we get a calculation for the fair value of the business, the intrinsic value of the business on a per-share basis, what that is, and then what we would be willing to pay based on the fact that we want a 50% discount. We want to pay 50 cents on the dollar to intrinsic value. So that's about it. So again, if you want to download a free copy of this spreadsheet and try and use it, you can via the first link in the description below. And if there's anything I missed in this tutorial that you don't understand or something you would like to see me demonstrate with the spreadsheet, then make sure you let me know down in the comment section below, and I'll be happy to maybe make some follow-up videos around the spreadsheet and maybe do some more detailed lessons around particular parts of how to use the valuation sheet, for example, how to actually apply it. So thanks everyone for tuning in today. I hope you guys get some value out of the spreadsheet and today's tutorial video. But with all of that said, hope you guys have a great day, and I'll see you in the next video.